Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we're bracing for market opening. We'll get the pre-open rates in just a bit, but we have our technical experts who are still with us. Mitesh and Sudarshan, we're waiting for their calls. Mitesh, you go first. Tell us what's the individual stocks you're looking at?
Morning, I have 3 buys and 2 of them from the HDFC group. Yesterday we saw a bulk deal in HDFC AMC, and there was a good price and volume candlestick and a price candlestick pattern and good volume action. That could give some kind of follow through today. That's a buy with a stop at 1740 for targets of 1815. HDFC Life similarly reversed from an oversold level. This could give a trading rally to about levels of 495, and that's a buy with a stop just below levels of 476. A buy on granules, where I would recommend a stop below 283.5 and a target of 300, and a sell on LTTS, which is large in Tubro Technology Services. That's a sell with a stop just about 34.60 for a target of around 33.50.
Okay, and Sudarshan, let's get your picks as well, the stocks that you're trading.
Well, IGL is a buying opportunity. See, it's a positional buy. Actually, I don't have any intraday suggestions for buying. The markets are too volatile to justify an intraday call. So IGL is a buy with a stop under 425. Persistent is an intraday short. Short selling should be done only intraday. Stop above 45.80. SRF is another stock that has been in a trading range and broke out yesterday. Another positional buying opportunity with a stop under 2200. And finally, Kotak Bank is a buy on dip. It's not a breakout, but it does suggest that perhaps it's bottoming out. That's a positional buy with a stop under 1650.
Okay, all right. Thanks a lot for that, Sudarshan, as well as Mitesh. We'll come back to you all at 9:10 for your call. Manoj Muralidharan, VP of Derivatives at Relicare Broking, joins us on the show. Hi, Manoj. Good morning. How are you reading trade setup, and give us your derivative strategies?
Good morning, Nigel. Nigel, I guess yesterday the good thing about the index was it did not make at least a newer low to what the previous trading session was. And the another positive side that we've seen is 17,000 strike, at least on the Nifty, has managed to hold on with good put writers. So the range happens to be that the FIs are still intact, the call writers at 17,200 are still there, and the put writers at 17,000 has just emerged. So the Nifty comes into a range of this 200 odd points. But every time if we see a gap of opening, you usually see that is getting sold off. So we are expecting that levels of at least 17,070 to 90. This would be a better level on the futures to go long. And there is a possibility of at least a 17,200 on the index. So it's a range bound session with a positive bias, at least for the Nifty. And that would be back more for the bank Nifty. Now, stock specific, even yesterday, Reliance, there was huge amount of short covering. Now, we believe that 2248 to 2250 is a weighted average price of this short covering. So we get a dip closer to that level of 2250 to 55 becomes a good buy with the stop loss of 2230. The target again comes closer to 2300, at least in the short term for Reliance.
Okay, Manoj, got that. Thank you very much for the trades there and a couple of the F&O ideas. We've got a very interesting pre-open today, by the way. It's only 2-3 minutes into the session. The Nifty was looking about 60-70 points higher. The Sensex was completely flat, and that's because on the Nifty, people are punching very lofty rates for 3 stocks, TCS, Infosys, and Reliance Industries. Reliance, now it's kind of settling a little bit. It's up 1.5%. TCS is up about 1.5%. The Infosys first rates were coming in about 4% higher. Perhaps there was a little bit of wishful thinking. And none of this was happening on the Sensex, which is why the Sensex rate was always very, very flat, about 12 points lower. Now the Nifty is kind of cooling off a little bit to a gain of about 42 odd points. So interesting trades. But even now, TCS, Reliance, Infosys, 3 big stocks, all pointing to the upside, at least as far as the pre-open rates are concerned. So that's what we have going on in the market for the time being. Siddharth Khemka is still with us. Siddharth, I just had a very quick question on HDFC Life, where we saw some buying yesterday. Now, we all know the whole story, how the stock has been beaten down, tax issues, etc. But do you think it's anywhere close to a bottom? What's your view?
Yeah, Sudhi, I think the core issue for the entire insurance industry, life insurance industry, came about with this lower growth that the industry has been facing for some time. And to top it all, the budget where the higher taxed people. So there were some changes with regards to the insurance claim that some people can take, and some policies were disallowed. So that kind of impacted the entire life insurance stocks as a whole. Having said that, I think one needs to look at this space more from a long-term story. The penetration in India is definitely lower, and that is gradually increasing, and that should help large players within the insurance space. But if you ask us, for us, HDFC has been trading at a very premium valuation for quite some time, and we have seen a strong time correction in HDFC Life. We believe SBI Life is the best and the most efficient player within the insurance space. They have the lowest exposure to this policy where the budget had disallowed, so that also keeps them on a safer side. Plus, their bank assurance channel, the growth in the insurance premium has been pretty strong. The efficiency ratios has been pretty good, and valuations have also been on the comfortable side. So I think within the life insurance space, we would prefer an SBI Life over an HDFC Life.
Okay. All right. Thanks very much for joining us, Siddharth. We will leave it on that note for this morning. Good talking to you as always. Just let's quickly get in a conversation going on the FMCG space, basically staples and even discretionary for that matter. Abneesh Roy, Executive Director, Nuvama Institutional Equities, is joining in. And the reason we've called in Abneesh is that we're all hearing about these El Nino concern, perhaps inflation being really sticky, and then therefore also rates perhaps being higher. Abneesh, good morning. Great to have you on the show as always. Now, you tell us, it's been a bit of a curious patch. Usually, when we have global disturbances, risk off in the market, money quickly runs to, the staple stocks, your Levers, Britannias of the world. That's not really happened this time, perhaps because of these concerns, you think?
Yeah, thanks. These stocks have high FI ownership. Currently, on the macro front for FMCG, one positive, one negative happening. So one positive, of course, we are seeing correction in the packaging cost, which will help also in the distribution cost because of the diesel prices also. So that's on the positive side. Yes, currently unseasonal rainfall is happening in many states. What we have picked up is currently we need to wait for the data. Today, government has said that this unseasonal rains don't seem to have much impact. But my sense is we don't have full data. Last year also wheat crop suffered because of very high temperature. This time the reason is different. So wheat crop could see lower output this time, which is negative for food companies. But the good part is palm oil will be lower and distribution and packaging cost will be lower. So on an overall, my sense is still food companies will see margin expansion in FY24. On the stock performance, yes, high FI ownership and FI selling has been happening. But yes, these are defensive stock. And as of now, El Nino is a key monitorable. And that would put rural recovery again at risk. We are seeing some green shoots, but my sense is in April, we'll have more clarity. And then in Q1 end and Q2, there could be an El Nino impact, which could again derail rural volumes.
Okay, all right. Hi, Abneesh. Good morning. Abneesh, what about individual stocks? How do you approach them as of now, given the current setup? Which are your top buys?
So from a Q4 perspective, we expect good numbers from paint stocks. So Asian Paints, Berger Paints, we are quite positive. We also expect margin expansion in Q4 and Q1 further because of the fall in the key raw material cost. Apart from this, we continue to like ITC and Godrej Consumer. These will report good recovery again in Q4 and FY24 also. Currently good visibility on both ITC and Godrej Consumer. Post that, we like Hindustan Unilever. For Hindustan Unilever in Q4, we expect again double-digit kind of sales growth with a healthy balance of pricing and volume. And margin recovery will be sequential. In HUL's case, YOY margin recovery will start from Q1. Lot of the other FMCG company, margin recovery will start in Q4 itself. So these will be our topics in the staples and the paint space.
So Abneesh, you're saying that margin recovery will continue to be a phenomena in Q4 because of lower palm oil prices and lower distribution costs. What about volume? I mean, you mentioned your expectations on lever. You're expecting good volumes to continue. But what about some of the other frontline companies? What do you think is going to be the salient feature, so to speak, of the fourth quarter? when it comes to both volumes and margins?
Right. For HUL, we expect for Q4 around 6 to 7% volume growth, which is slight acceleration from the 5% seen in Q3. My sense is this is not a pronounced rural recovery. This is more of a base effect helping many companies. Even for Dabur, for example, which had a -3 volume in Q3, our sense is it should be closer to the flattish, which again is an improvement. So for many companies, we see improvement. For paint stocks, we expect double-digit volume growth, double-digit sales growth in Q4 for the bigger paint companies. And margin improvement will also happen because in Q3, the higher price inventory was still being used. Now that is definitely over. So for most companies, I think the prices of raw material will be at the more lower level versus a Q3. So yes, Asian Paints, Berger Paints, ITC, Godrej Consumer and Britannia, these will report the best numbers in our view. In terms of the laggards, our sense is the hair oil companies and the liquor companies, they continue to be at the lower end in terms of operating performance.
Right. Abnish, very briefly, any thoughts on companies in the QSR space, Devyani, Barbecue, etc.? Stocks have seen a fair bit of damage. Good prices to buy, get in?
Good question. So we'll be overweight on staples currently in terms of the QSR. Two issues: hyper competition, everyone is expanding, and second issue is definitely higher cheese prices. And now again, if wheat also gets impacted, that also remains a monitorable. So dairy has been extremely inflationary. So I would be underweight on QSR. We'll be overweight more on staples, more on paints. See, paint is also discretionary, but there it's a 5-year cycle in terms of buying behavior. All these job losses in startups and IT, it's more impacting the QSR and the apparel rather than the paints.
Okay, all right, Abnesh, appreciate you stopping by and giving us your take on the sector. Look forward to having a chat with you in the near future. Well, let's get the 9-10 calls then. Sudarshan and Mitesh are back with us. Sudarshan, you go first. What's the 9-10 call?
Well, SRF is a positional buy with a stop under 2200.
Okay, Mitesh, what about you?
I'll go with a buy on HDFC Life with a stop at 476, target of 495.
Okay, thanks a lot for that, gentlemen. Well, let's hop across to Nimesh. He's standing by to run us through the standard brokerage report that he's picked up. Morning, Nimesh.
Morning, Nigel. So, we've been seeing a lot of downgrades on the Indian IT names for the last couple of days, and Rima has been pointing out as well. Today, Bernstein has downgraded a couple of Indian names. Largely, they've downgraded Wipro to underperform. There, they've cut the target price sharply to 310, largely on back of weak, growth outlook and highest exposure to the BFSI space. The other stock that they've downgraded is L&T Technologies. To underperform there as well. There they've got the target price of 3050. Largely, Bernstein believes that the growth impact will be much higher for LTTS on the back of vendor consolidation, and the multiples are quite high for L&T Technologies, and hence a downgrade there as well. They've been selectively positive on some IT names in the large cap names, which includes Infosys, which is the top pick, followed by TCS and Tech Mahindra. Overall on the industry, they have cut the revenue growth forecast for FY24 by 3 to 4% and earning estimates by 3 to 9%. Financial has been the biggest vertical for most of the Indian IT names, which contributes nearly 30% of the revenues, and that's where the big challenge is going to be for Indian IT names. So on back of that, today they've downgraded Wipro to underperform, target price at 310, and they've also downgraded L&T Technologies because of the higher multiples.
All right, L&T Tech lost about 3-4% yesterday, so that's good to get. Nimesh, thanks very much for that. Now, insurance companies are in focus. CLSA says that valuations have corrected quite a bit. Surbhi's got more. Surbhi.
Life insurance sector has been in focus since the budget day, where they announced taxing high ticket size insurance policies. Now, CLSA has written an extensive note on the sector, and they say the life insurance players have corrected anywhere between 7 to 24% since the budget announcement. They say that the current valuations factor in 0 to 4% growth in the medium term, and their own base case factors in only 5 to 10% growth in APE and VNB over the next 2 years, as opposed to 12 to 24% prior to the budget announcement. With all the negative priced in, they are upgrading SBI Life from outperform to buy with a target price of 1325. A sell to underperform on HDFC Life, where the target price is also raised to 500 from 460 earlier, and an underperform to buy for Max Financials, and they maintain the outperform rating on ICICI Pru with a target price of 485. For SBI Life, they say that it's least impacted with the budget announcement, and the low cost ratios and strong distributions remains their key strengths. For HDFC Life, they expect a faster increase in a wallet share from 58% to 70%, and that will offset the budget negatives. And for iPro and Max Financials, they haven't factored in any growth post FY25, and they say the promoter leverage for Max Financials still remains an overhang.
All right. Surbhi, thanks very much for that. We're just waiting for market open, which should come up shortly on our screens. Just 30 seconds to go. Now, the question, of course, is going to be whether the gains which we will see right at the word go will last, or if they last, will they last all the way till 3:30? Will we see something different towards close as we go into that Fed decision, which is, of course, later tonight? But that's a big one, and I think understandably the market will be watching that keenly. But the fact is there has been a fair bit of damage which has been inflicted here over the last 7-8 trading sessions, even as markets where this problem has been festering, the banking issue, that's been largely unscathed, at least on big indices. That's the open. 17,185 is where we are at, 75 points higher, and it's a good start. You've got the other indices coming up. The Nifty Bank, which is up about 0.25%, about 106 odd points. I mean, actually, with this gap up that we've seen, it's almost at that 17,180 kind of level, 17,200 levels, which is where there is some selling pressure expected. Crossing that and maybe sustaining above that, a close above that will be good to see. Now, let's just look at the other kind of large stocks, if we can, especially on the Nifty space. SBI Life, HDFC Life are the two gainers, 1.25% each on both those names. Insurance is a sector which Surbhi was highlighting just a while back. It's a space which did well yesterday as well. Bajaj Finance is coming up with about a 1% gain. And you've got HCL Tech, which has got about 1.25% in terms of gain as well. On the downside, there is Asian Paints, Coal India, and Apollo Hospitals, which are down 0.5% each.
All right. Just looking at a few more stocks. Then Imami, they've announced that they'll be considering a buyback. So that stock should be in focus. Let's see what it's doing for initial start. I think it was well in the green. The other one is Sonata. They have signed a $160 million deal from a retail client to manage its IT modernization and transformation. So that as well is a large deal out there. That stock was up close to around 3% in initial trade. BL Kashyap, we don't talk about it very often, but the Railways Land Development Authority has given them a project worth around 313 crores odd. So that is higher. HG Infra, L1 bidder for North Central Railway project worth around 655 crores. So that was up close to around 2%. And Devyani and Greenlam post a couple of large trades. Both those two stocks are in focus. So let's see what the initial tick is on both of them. Devyani mildly higher with the gain of close to around 0.5% out there. And you had Greenlam, that is more or less flattish. Surbhi?
Well, life insurance is definitely a theme in this market, and there's buying across the board on all of the major life insurance stocks. HDFC Life is the winner on the Nifty right now, almost a 2% up move. Make that the same for SBI Life. ICICI Prudential up about 2%, 1.5% to 2% as well. So life insurance is a very clear theme that's emerged. IT continues its pullback, so TCS is still seeing some gains. Infosys, Wipro, these are names on the upside. Bank Nifty is almost in sync with the Nifty, so not too much problem there, at least as of now. HDFC Bank is sitting on the fence, absolutely flat. So let's see where that one shifts or tilts, and that'll have a bearing on the index as well. Just wanted to mention that in some of the stocks in news, Sobha, because of these IT searches that are going on, that's a stock that's opened down about 3.5%. But Hindustan Zinc with that mega dividend, that's the one that's really running away, about 3.5% up. But overall, market seems to be holding with this 0.5% gain, at least for the time being. Prashant, underperforming some of the Asian markets, but nonetheless, is building on yesterday's move.
Absolutely. Almost 17,200, right? That's where we're at. I think you mentioned Max Financial, right? That's a big move on Max Financial. That's a 7% pop, if you can have that up. 671. Life insurance is doing well. Max Financial is anyway, the cheaper of the lot. The cheapest, actually, and that's a big one coming through on volumes, and that's why I'm mentioning that. SBI Life is up 2%. That's more regular kind of gains. Bandhan Bank is up 2% as well. There was news flow on exchanges earlier. Hindustan Zinc is up about 3.25%. The Adani Group stocks, Green and Power. Green is up 5%. Power is up about 3% or so. Adani Total is up about 4%. HDFC Life, we mentioned 2% higher. Sonata Software, there was some news flow, 3% higher on Sonata Software. Persistent is up 2%. LTI Mindtree is up 2%. Coforge is up 2%. Emphasis is up 2%. So it's basically a reversal on IT from yesterday. Yesterday, IT got sold. Today's IT is higher in trade. Almost all of these names were down almost similar percentages, and there is a bit of a reversal which we are seeing right there. 1.33% higher on the Nifty IT index. Yesterday it was down 1%. Our market master of the day is S. Narain, Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. If I dare say, one of the best-known contrarians in the market, someone who puts his money where his mouth is. He's been telling us, Narain, we spoke earlier in the year, at the start of the year almost, and at that point you were pretty cautious. You were still of the view, which you carried on from late 2022, that there is perhaps more pain to go. You were sort of advocating allocation to debt schemes, to debt as an asset class, basically. How are things looking now? Your view has worked out pretty well. How are things looking now? Is a lot of the froth out of the system? And how much more downside, according to you?
See, at 17,000, valuations are much more reasonable, and the global macro people are just too short on everything. And we have a Fed meeting today, and it is possible that there can be a good relief rally. If all the shorts in the system have to be taken out, there can be a very good relief rally. Does it mean that you can have very big returns in equity from here? The answer is no at this point of time. But is the market tactically well poised at this point of time? Certainly, because the global funds have just turned too negative at this point of time without reason, because they had to go short somewhere and they found India a good place to go short. So I think tactically we are very well positioned, but at the same time we don't believe in very big market rallies.
Okay, Narain. Well, I guess some of that caution and a bit of a reality check is very good to always have on board. I want to talk to you specifically about India. We'll wait to see what the Fed does and we'll see what's happening to those Western banks. But with respect to the market here in India, I guess the good thing for investors is that now valuations have cooled off. We're no longer trading 1-2 standard deviations above our mean as we usually do. So in that context, which part of the market looks most attractive to you, where perhaps you would be happy to deploy fresh money as well?
See, clearly there are areas like banks, for example, which are much more reasonably valued at this point of time. The problem with banks at this point of time is every one of the domestic funds and every one of the global funds has roughly 25-30% in banks. So if there is a redemption, people have to sell 25 to 30% banks. So till you see good inflows, banks don't perform, not because it is attractive and unattractive, but because it is a big holding in every fund. So I would say banking is certainly something which is attractive. Certainly if you look at it, auto is attractive because of all the consumer discretionary stocks, this is one of the sectors where in the last 10 years there has been very low growth. So people don't put implied growth assumptions which are ridiculously high. If for the last 6 years, two-wheeler industry hasn't grown or passenger vehicle industry hasn't grown, people don't put implied assumptions which are very, very high. So that makes the industry much more reasonably valued compared to many of the other consumer discretionary industries. Clearly, telecom is a sector where there is still scope for over a next 2 to 3 year period for ARPUs to grow from here. So these are some of the sectors where there is upside potential. The way technology has been tanking, clearly that is another sector where there is scope for re-rating over a longer term period. Pharma as a sector has done extremely badly, and again it is a sector where there is scope for returns over the medium term. So there are multiple sectors where, as you can see, over the last 18 months to 24 months, valuations have corrected. And, if we get many new age stocks also very, very cheap in some of the NFOs, IPOs, if they were to happen, even they can be considered because they are no one is talking about illogical valuations. So if they come at very low valuations, even we look at some of the new age companies also.
All right. Hi, Mr. Narain. Always good hearing your thoughts, sir. Nigel on this side. I wanted to focus on two sectors that you just spoke about. One was on the banks. The PSU banking theme worked out very, very well last year. And I think you were in the camp that was quite positive on that space. Do you believe it still offers value? And on the telecom space, the ARPUs are likely to move up, and you've been positive on that space as well. What kind of hikes are you factoring in for this year?
See, everything that we decide, like for example, if you take telecom, it's not something that the ARPUs need to go up this year. It will go up over the next 2 to 3 years. Will it go up in the next 6 months? We don't know. It may go up, but will it go up in the next 2 to 3 years? Certainly. I mean, when can you can't actually exactly time. This is exactly like PSUs 2 years back. In 2020 October, most people said PSUs will never deliver return. Could we have predicted when PSUs will deliver return? It is something like that. You can't predict when the ARPUs will go up. Aren't Indian ARPUs very low compared to the world? The answer is yes. Will they go up? They will go up. Can we predict the timing? Answer is no. So that's as far as telecom is concerned. Banks have seen a first round rally, and they are no longer as cheap as what they were. I think next, if there are no big credit events over the next 2 years, they can re-rate. But no longer are some of the banks as cheap, PSU banks as cheap as they were. They have corrected in the last 3 months, so that gives you scope for some near-term rallies. But for the banks to perform, we should not have credit events, and that is a challenge actually in PSU banks at this point of time. Because a year back or year and a half back, they were priced as though they will never grow, they will never be able to create profits. Today they are sitting on record profits. So from here on, you don't need profits to grow as much as to have that profit should not go down because of any credit events.
Just a quick point on valuations, right? Yesterday we had Sanjay Mookim of JP Morgan, and we were talking to him. He said the problem is that there is no historical valuation, because valuations have only gone up over the last 10, 15 years. I mean, it's like an upward sloping sharp curve from where we were at 12, 13. Multiples have gone up very sharply. So when you say we are at 17 times now, 10-year average is 17 times. Just trying to understand how you think about these valuations. What do you consider a fair kind of multiple to look at?
Yeah, actually, that's where, I have trouble telling investors, 2008 to 2021, you had printing presses in Washington and Brussels. Even now, printing presses are on in Tokyo. So you have to look at valuations in the next 5 years. You have to take a call whether the printing presses in Washington and Brussels will again reopen or not. If the printing presses in Washington and Brussels will not reopen, you can't put the last 10 years valuations all the time, because at that point of time you got zero in debt. And because you got zero in debt, people invested in equity. So should you use the last 10 years valuations or not? That's why when I tell investors you can't get 15% per annum easily in equity, people start looking at me as though I'm a bear. I'm not a bear, but I'm a believer in more moderate equity returns, because you don't have printing presses operating in Washington and Brussels. If due to all the global events, tonight if Fed comes and says, I'm going to start quantitative easing, then I'll change my view and say we are going to get much better returns in equity than debt. But if Fed continues to say inflation is a source of worry, I am not going to print money, then you're still in a moderate return world. You're not in a high return equity world, because 2008 to 21 was backed by record printing in Washington and Brussels, and every Indian corporate which was credit worthy could get money in global markets at less than 1%. Today, when they want to borrow in global markets, they have to pay 5 to 6%. That's a big change. And that change people don't want to understand. And that is why big returns in equity market require much lower interest rates in the Western world.
And that's such a beautifully put, Naren, and such an important point. So what is the framework you are using right now? I mean, of course, when the facts change, as you said, you'll change your mind. If QE starts again, you change your mind. But I remember that in our last interaction, you said that macros are going to be very important in the next decade. So I'm assuming you have a view in terms of how you're thinking about this. Will interest rates remain relatively higher for some time to come?
See, that we don't know. That depends on the Fed. But what we told as the outlook for the year is SIPs, STPs, booster STPs, asset allocation, multi-asset funds, fixed income. This is what we said. After the market fall, we are saying there is a lower downside in equity than before, certainly. And that's the reason we called it multi-asset as the most important asset class. And look at what happened to gold recently. And it is not that gold is attractive at $2,000. We don't think gold is attractive at $2,000. But we believe multi-assets is the way to go because, at one point of time, gold protected portfolios. At some other point of time, debt will protect portfolios. At another point of time, equity will protect portfolios. But we are not in a high return world till the day Fed starts QE or till the day Fed starts saying interest rates will come down to 3%, we'll bring down interest rates sharply. Till that point of time, we are in a moderate return world and we are not in a high return world. And that's why we have been very, very focused on asset allocation. We have been focused on categories like balanced advantage. But at the same time, what we think is, value is done extremely well. We think growth and innovation is also something which we have to look forward. And that is something we are thinking about at this point of time.
I take your point, Naren. And value is the area that I really wanted to come to because you are the original contrarian of the street, right? I remember coming to your office so many years ago and you were looking at a lot of these power stocks which nobody wanted to touch in the market at that point in time. Which brings me now to my question. This whole trade that's been ongoing, both on power as well as capital goods, it's been almost a sort of a one-way move over the last couple of months. Is this getting a crowded, fashionable trade? How should medium-term investors look at it? How do we look at multiples for a stock like NTPC, for instance, which has rallied a lot, but it's nowhere close to its 2008 highs?
See, we can't talk on stocks, but the moment stocks start trading at 15 times price to earnings and 20 times price to earnings, then we start getting worried. If they start trading at 2 times book, then we start getting worried. So like what happened to some of the new age companies, they were all trading only on sales basis. So till the time stocks trade at 2 times book and 3 times book, we are very far away from them at this point of time in sectors like power. Capital goods sectors are trading at high valuation, but the stocks are so illiquid that barring 1 or 2 companies, the other companies, you can't even buy $200 million or 1,000 crores worth of stocks for a big mutual fund like us. So that's the difference between when I was running infrastructure fund between 2004 and 7 and now, that there are hardly any capital goods stocks with liquidity at this point of time.
Okay, so then let me just follow that up with a question on this whole capex move that we're talking about. Government capex is a reality. We see that in numbers. Then how do you look to play it? Is defense an area that you would consider? And are you at all looking to poise your portfolios for a pickup in the private capex cycle?
See, there is no doubt that, between capex and consumer discretionary, capex is a much better way to play it. But capex is not an easy way for stock picking. What stocks do you buy? That's one of the reasons, banks appear as a much better way to play the capex cycle. For banks to deliver returns, you need good inflows into markets, a much more positive macro environment in the world. But banks are the best way to play the capex cycle because at least you're able to buy billions of dollars worth of stocks for any fund manager in the world. So I think in this part of the cycle, whether it is banks, it is cement, at some point of time it would be metals. These are the sectors that you would have to play for the capex cycle because the capital goods stocks are not liquid enough for a large fund like ICICI to be able to buy because there are hardly 1 or 2 stocks in the capital goods space where we can put $1 billion to work.
All right, Naren, what about the real estate space? Everyone was talking about, we're in the initial 2-3 good years and then we have a longer run out here. Interest rates have gone up. Are you in the camp that believes that real estate will do well from here on?
See, as a structural multi-decadal opportunity, it remains. But right now, after the good move in interest rates, it becomes difficult. And, the recent way in which, some of the IT companies cut salaries, I'm a bit confused right now whether to bet on the long-term structural story in real estate or to look at the tactical part that you have had a big increase in interest rates and a drop in salaries and the fact that some of the IT companies have even cut headcount. So which of the two to take, I'm a bit not clear. So I would say we are somewhere in the middle on real estate. But if a person wants to invest and not look at the share for the next decade, maybe I think it's an interesting sector to look at.
Naren, how does you briefly mentioned even new age companies, right? Which may look attractive. Are they already looking attractive in many cases? And can you tell us which are the ones which, because it's a bombed out space, which are the ones which are looking attractive to you, to your team?
See, I think very few have got listed, and I think in the next few years, many more will have to get listed. I'm hoping that the private equity and venture capital funds which own them, they will come at a good valuation because they've realized that there is no way they'll be able to come at absurd valuations, and the global environment for growth stocks is not what it was in 2021. And many of the private equity firms do need exits at this point of time. So I'm hoping that they will come at attractive valuation. The number of new age companies which are listed at this point of time are very few, and many of them have already made corporate governance mistakes. Suddenly one of these companies says, I want to buy another company. And these kind of things, they don't seem to know that once you're a listed company, you're answerable to all kinds of shareholders and you have to behave as a good corporate citizen. They have to learn from some of the older companies which are listed in India. So there's a lot they need to learn, and I believe that that's a very interesting space for us. I must thank the first few listed companies in India for making mistakes, because otherwise we were very worried that they will come at absurd valuations. There has been a good fall in valuations of some of the first companies which got listed, which means that the following companies will have to come at much better valuations for the benefit of the mutual fund investors.
So let me just, dig a little deeper on that point, Naren. When the first lot came in, as you said, it was all about price to sales. There was no idea of profits. We were just looking at valuing on whatever the number of subscribers of the sales are. As a money manager now, would, let's say, earnings still be your first lens or your first filter? Would you expect that from the new lot? As someone who's deploying money, what are you looking for as you look to buy some of these new age businesses?
See, we have to look at whether they have created a good entry barrier, whether that market is capable of growing, whether there is a way in which they're going to make good money 2 years from now. There was a point of time, when we looked at some of the, even some of the private bank in 90s, they used to trade at, the best private banks in 90s used to trade at 10 price to book, and we used to ask, is it worthwhile? But, over a point of time, they all grew. So, we have to do much more growth-oriented thinking. I've left it to some of my colleagues to actually do that thinking and come to a conclusion that some of these companies will grow. They have created moats which are not easy to actually replicate. And if they have good management teams and ability to actually run the businesses well, and they also know how to manage capital allocation. Because these are all young companies run by young founders who don't have experience of managing public listed companies. So there's a lot of challenge there, but it's very interesting actually. And the way these stocks have derated makes it much more interesting at this point of time than what it was in 2021 when all they sold was stories. And at that point of time, we used to be much more worried about them than where we are in 23 March.
All right, Naren, final question then from my end. We had a very good budget, focus on capex as well as infra. However, the rural economy is in a bit of pain. Now we're talking about unseasonal rains as well. Do you think, the government's bandwidth or the resources, attention could shift from the capex to the rural economy, which in turn will not be very comforting from an equity market perspective? Your sense on that? Is that a risk?
I don't think, I think anything which benefits the K-shaped recovery has been there. And if anything that the government does to help the bottom 1,000 million people in India will be viewed as positive for the market, because it helps the entire consumer staples sector, it helps the telecom sector, it helps the healthcare sector, it helps even sectors like cement. So I don't think if you believe that helping the rural sector is going to hurt the Indian equity market, far from it. I think we need the 1,000 million people to actually grow as fast as the top 100 million people. And that's what I'm sure that the government is interested in. And without that, I don't think we are going to have a very good growth story for the next 10 years. So I think any support that the government does to help the rural people and anyone in distress will be seen as very positive for the markets in a medium-term basis. And I'm sure they'll find the resources for it, because look at the kind of improvements that have been seen in the computerization of taxation, GST, etc. And that's the reason for a superb increase in tax collections in India. And as that keeps on improving, I think that resources will be found, and that's needed to help the rural sector and anyone in distress at all points of time.
Naren, as we come down to last thoughts, let me ask you a question. We would never ask, someone like you about where the market is going, but allow me that this one time, because this has been a very interesting year. We started off with India underperforming, then we had an Adani event, then we had these foreign banks blowing up, then we had, runaway rates and sticky inflation. As you're looking at the rest of 2023, what's the best case scenario for this market? Maybe a time correction, maybe just a year of no returns, or can it actually be more optimistic and better than that?
Yeah, actually, sitting in a mutual fund, we think this is a year to actually invest for the long term without looking at what happens to the market in 2023. We think, compared to 2021 September to March 2023, we think that 2023 March to 2023 December is a period to invest in, to reap returns in 2025 and 26. What happens to the market in 2023 is a question that you should ask what happens in Fed. You should ask Jerome Powell at midnight today, because I think he's a better judge of what will happen to the markets this year. But that's not our goal. Our goal is to generate long-term returns for our investors, and for that, this year is a better accumulation time than 2021 or 22 for that matter.
All right, there you have it. You know what to do. All right, Naren, it's a pleasure, absolute pleasure speaking with you. Great conversation as always, and very, very sort of balanced commentary, very useful for our viewers. Thank you so much for your time here on CNBC-TV18. One of the most candid, straightforward investors, a complete contrarian, has sort of done this a long time and outperformed the market a long time as well. S. Naren, CIO, ICICI Prudential, AMC. We'll take a very quick break here. The market's up, 55 odd points or so at 17,161. We are back with the management of Century Plyboards. We'll talk to them about their business outlook. Later, we'll connect with the management of Anupam Rasayan to discuss their demand and business outlook. Stay tuned.